Good morning and welcome to today's edition of Investment Conversations. I am Mohini Naidoo and it is my absolute pleasure today to welcome Omri Thomas, Portfolio Manager of the Nedgroup Investments Opportunity Fund. Omri has been managing the fund since its inception in 2011 and has built up an impressive track record over the last 10 and a bit years. Last year, the fund delivered a staggering 31% versus the average of the ASISA multi-asset medium equity category of just 17% and 29% for the ALSI. For the 10 years ended 31 January, the fund has delivered an annualized return of 10.2%, outperforming the peer group average by 2% per annum over this period. Omri, welcome.
Thanks,
it's great
Mohini.
to have you here.
Nice to see you again.
Yeah, I can honestly say as an investor in the Opportunity Fund myself that it has not been a dull 10 years.
Absolutely.
Now, while last year was an exceptional year,
Yes.
the fund's long-term investment objective is to deliver inflation-beating returns, inflation plus 5%, as well as a dual capital preservation objective
That's
over
right.
rolling two-year periods.
Yes.
So what are some of the techniques and strategies that you have used to achieve this over the last 10 years?
Yeah, Mo, you spot on. So, I mean, it's got that dual objective. So we try and look for ways to structure the portfolio that we get an asymmetric return payoff profile. So that will both be implicit and explicit. What I mean by implicit would be things like portfolio construction, the asset classes that you use, the weightings towards the asset classes, and then also the security selection within those asset classes to try and structure the payment profile like that. Explicit would be specific things that we include in the fund. So that would be structured notes that we structure to get that asymmetric payoff profile, as well as using hedging. Now we've used hedges now over the last 10 years, and as we've gone along, we've learned some important lessons. You'll remember a couple of years ago there was Steinhoff, which we had a hedge in place. That didn't work it well because Steinhoff fell from 90 to close to zero. So we've learned a couple of lessons and to try and refine those techniques and use that to achieve that dual objective.
So the last 10 years have also been a period of, ultra low interest rates globally,
Yes.
low inflation rates, but we now see a bit more tightening in monetary policies around the world and certainly an increasing interest rate environment.
Absolutely.
So does this strategy remain relevant going forward in a environment, in this changing macro environment?
That's a good question, Mo. And as we just referred to in the previous question, there's a dual objective. On the one hand, you want to protect capital. On the other one hand, you want to share in some of that upside and try and maximize that upside. So it's constantly a shift between, call it a return on capital to a return off capital. And it's moving between those two different objectives and weighting it towards the one where there's a bigger opportunity set. Now, the last 5 years, or actually since the global financial crisis, we've been in a very extremely accommodating monetary policy environment. That's been very supportive for risk asset, very supportive for equity markets. So it encouraged investors to take on risk. I think in this environment where interest rates are now increasing, inflation seems like a bit of a risk. The return of capital and the protection of capital has got a much higher importance in a portfolio. So even more so now, I think those objectives are relevant, especially in the market environment that we're now in.
You've mentioned in your earlier comment the structured notes.
Yes.
And some hedging strategies.
Yes.
What are the costs of these protection strategies, explicit and implicit, and do the costs outweigh, and do the benefits or potential benefits outweigh the costs of these strategies?
Yeah, it's a good question, Mo. So typically we try and structure these structured notes as well as the hedges that it's a zero premium, so zero cost to the portfolio. But there's, as you say, so the explicit cost is close to zero. The implicit cost is normally upside that you give away. But in this balanced mandate, we're happy to give away the super returns for the luxury of having that capital protection. Typically, the structured notes that we structure, we've got sort of a 40% capital protection, and that deep protection provides you with a lot of comfort that you are able to sleep comfortably at night, knowing that that capital protection is there. At the moment, I think we've got almost 10% of the fund in those structured notes. We've also got a few hedges over some of our bigger positions. So yes, it comes with an opportunity cost, but given where markets are now, we're happy to take on that opportunity cost within the fund.
Omri, let's come to one of your favorite stocks in the portfolio, if not your favorite stock of all time, Naspers. So we saw a big sell-off in tech globally with the increasing Chinese regulatory oversight, and Naspers is holding in Tencent. So we saw that the share price fell something like 18% last year, and correct me if I'm wrong here, this was the largest single year decline in the stock in more than a decade and a half. So how does one protect against such an event?
Yeah, Mo, that's spot on. Naspers has been very disappointing. In fact, I think over the last year till where we are now, the stock is almost down 30%. So given the big size that we've got in the position, one would have expected a much bigger impact on the fund, and that's exactly where the hedging came in and protected the fund against that fall. So we had a huge hedge over a big portion of our position, and that really worked well. Where we are now, we think that the risks are more balanced. A lot of the regulatory risks are now priced into the price. We've already seen a big global tech sell-off. So where we are now, we think the focus on fundamentals will return. You're still getting Naspers at a significant discount to net asset value on a much reduced price of 10 cents. So we still like the story, we still like the growth potential of 10 cents, and we think most of the regulatory risks are now priced in.
Okay, so if we can take a step back and look at the overall portfolio,
Yes.
How are you positioned today to construct a portfolio with that asymmetric return profile of giving you sufficient market participation while protecting on the downside?
No, it's a good question, Mo. So as you would surmise from our earlier comments, we have become a lot more defensive in our positioning. So we have reduced the equity exposure within the fund. And I think there are enough other building blocks that offer you very attractive real and nominal returns that you can substitute the equity reduction with. And that would be things like SA government bonds. I mean, SA government bonds, you can buy a 14-year bond now yielding 10.5% with inflation running, say, 4 to 5%. So you're getting a 5 to 6.5% real return, which is similar to an equity risk premium that you're getting in bonds for 14 years. So for us, a lot of that's a big buffer for macro shocks that's already built in. And it gives a very nice floor to your return. So over the last couple of months, we've significantly increased our holdings towards SA government bonds. So that was running at about 5%. It's now mid-20s within the portfolio. And again, if you look at the overall yield for the fund, it provides a very nice floor to your returns. So at that high nominal yield level, even if you see a sell-off in bonds of, say, the rates increase 1.5%, on a year basis, you actually still get your capital back. So the price has dropped, but you've received 10.5% in interest coupons. And then your new starting yield is 12% for the following year. So if you take a 3 to 5 year view on a balance of probabilities, we would expect you to receive a very healthy return from bonds at probably less volatility that you're going to get in equity. We're still constructive on some areas of the equity market, but I mean, we've had a very, very strong recovery since the COVID lows. We are moving into an increasing interest rate environment. So I think your risks are more balanced now. You could see, we're going to probably see a bit more volatility as interest rates increase. So I think you want to be more tactical
on your equity and your stock selection there. And we've both reduced our equity and increased the defensive nature within our equity component. So British American Tobacco, still a very big position within the fund. Luckily, we've seen a very nice recovery in British American Tobacco. We're expecting results from them soon, and we expect them to announce that they're going to do share buybacks. Despite this recovery, it's still trading at a single-digit PE at close to an 8% dividend yield, and that's a pound dividend yield whilst they're growing earnings. So again, if you think of the defensive nature, the high yield component, that fits that theme and supports the return profile of the fund.
Omri, the mandate does allow you to have up to 30% offshore, and you've mentioned some of the rand hedge positions.
Yeah.
What is your feeling in weighting towards offshore versus SA Inc. at the moment?
Yeah, it's a good question, specifically given the political situation. It's always interesting in South Africa. I think what has surprised us is the strong fiscal position of South Africa, driven by obviously high commodity prices. And that's provided significant support for the rand. And we don't see that turning around soon. So that's going to continue putting a bit of or giving the rand a bit of support. So where the rand is trading now, it's probably not too far off fair value. If you look at the fundamentals, so growth, our trade balance, and our inflation differentials. So we think that the rand is fairly valued. So despite us having low offshore exposure, we've actually supplemented that with currency futures, just to protect the fund if there is some kind of a risk event and the rand suddenly sells off. So our true FX exposure, excluding rand hedges, is probably about 25%, and then you can add your rand hedges like a Naspers and British American Tobacco to that. So if you look at it on a see-through basis, you're probably looking at about I would guess a 40-45% rand hedge exposure.
Great. Omri, I think that's about all we have time for. I suppose one last quick question is, where would you see the portfolio fitting into an investor's overall diversified portfolio?
So I think this is a portfolio that one can buy and hold for a long time. So the objective is to, over time, compound returns at an inflation beating rate. And if we keep on delivering on that mandate, over time, you'll see your total portfolio growing nicely. I mean, you mentioned the 10-year track record. I mean, we're very proud of the sort of long-term compounding above inflation and having managed to beat competitors at sort of 2% per annum. Now, if you compound that over 10 years, it ends up to somewhere in the 20s. So we do think in the current environment there's sufficient sort of return potential to continue to deliver on that mandate.
And I think one of the characteristics of the fund is how differentiated it is because of these additional tools and strategies that you use. So perhaps blending it with other funds within the multi-asset medium equity category, and perhaps even the high and low equity categories, because it's still delivering on that inflation plus objective of the high equity categories while providing that capital protection for the low equity categories.
That's a very good observation, Mo. I think if you look at the correlation of the opportunity fund to other balanced funds, it's quite low. So using that in a blend does help that return profile. And I think the one other point to make is if you look at the return history, I mean, there've been a few hiccups. So performance doesn't come in a straight line. I mean, there was a start-off a couple of years ago. There was the sort of COVID sell down. So the performance track record must be looked at, including a few periods where returns were weak, but we were very, very pleased that over time we've still managed to deliver on those mandates.
And so are we, and I hope our investors are as well. Omri, thank you very much for your time today and for sharing with us all of those detailed insights on the fund. So as always, thank you to our viewers for joining us today. And as Omri mentioned, fund does experience periodic episodes of underperformance, but I think there is sufficient evidence to demonstrate both locally and globally that even the best fund managers experience periods of short-term underperformance in their pursuit of long-term outperformance. So, Omri, if you could just make sure that the fund continues to deliver for the next 10 years.
I'll give it my best, Mo. Thank you.
Thanks very much. Bye-bye.
Bye.
Bye-bye.